Yield curve control. I think a lot of people tend to get tripped up with this because bond yields and bond prices move inversely. So when you say, if the bond yield goes over a certain threshold, they start buying it, they start printing money to buy it. What they're actually doing is then buying the government debt to support its price in the marketplace.
Exactly.
So why are they doing that? What is the danger of the government bond going below a certain threshold? Is this optics? Is this, what are they trying to prevent when they do this?
They're trying to prevent, sovereign debt crisis, right? At 266% debt to GDP, you can't let yields rise at all. Like you will blow out completely if you let yields normalize with the rest of the world. And so this is that dilemma I was talking about earlier is, as the rest of the world's yield curves began to rise, as all the central banks began to hike, the Bank of Japan had to stay at zero. Like they don't have an option. Here's some math for you. At 266% debt to GDP, if Japanese yields went to where their Fed is, they would eventually be paying 13% of their GDP in interest alone every single year. And so that's 2.5 times what the government makes in revenues.
Right.
And so you can't pay that. And so the only option for them is to, push the yield curve down to zero, push the bond prices up to par, and just basically say, these bonds are money good no matter what.
Right.
And the central bank stands ready to buy any and all bonds that you want to sell.
So when I had Lynn Alden on, she described yield curve control as financial repression.
Yeah.
So they're, I guess, then limiting the amount that savers can earn, right? Because yields are at zero or negative. But then they're expanding the currency supply to buy government debt. So you're penalizing or stealing from savers and limiting the yield that they can get in traditional markets, basically. So is that what's happening here, basically? Is that savers are being robbed to pay government debts?
Essentially, yeah. And more so, what the central bank is trying to do is they're trying to stimulate those savers to spend their money.
Right.
Because they're trying to stimulate inflation. Because the lie that the central bankers have always told, right, is economic growth is dependent on low or moderate constant inflation.
Right. This is the pseudoscience Keynesian economics that this whole thing is based on, right? That we must increase consumption to increase production, which is the opposite of economic reality, right? Production precedes consumption. Yet Keynesian economics inverts the whole thing. Hence this psychotic monetary central planning, basically.
Exactly. Yeah. And it inverts also, financial markets and real, in that, the financial markets should be based on what happens with the real economy. If real GDP grows, financial markets, earnings should improve, corporate profit should grow, and then, obviously more money should flow into stocks. But instead they say, well, we need to, to save the real economy, we need to inflate financial asset prices, which is the inverse of what that correlation should be.
Right. Wow. Yeah. Unbelievable. So this has led to a situation where the Bank of Japan, I think you said their balance sheet is a certain percentage in excess of GDP.
Yeah.
And they own the majority of their own government's bonds. What are the consequences of that? Like what when the central bank ends up owning most of the government debt or has a balance sheet that's in excess of national GDP, for instance, why is that a bad thing?
It's a bad thing because you essentially are killing your own bond market, right? So in 2023 and 2022, quite a few Bloomberg articles came out showing that multiple tenors of JGBs were not trading at all. So like 10 years, 3 years, 5 years, they were all just not trading for a week and a half, because there was no one that was willing to buy or sell. Because the Bank of Japan itself, they own about 53% of the entire JGB bond market. They own 70 to 80% of quite a few tenors, including the 10-year, and they own over 100% of some issuances. And the way that's possible is they bought literally all the bonds that exist and then they loan them out. So technically it's a short that they are owed. So they own more than quote unquote own more in accounting terms than all the bonds.
And what do they loan them out to do? Is that for more?
They are loaning them out usually, for collateral purposes. Banks will use JGBs to, finance a Forex trade or cross-currency basis trade. It's usually collateral that they need, but because the banks don't actually want this JGB. That's why the BOJ has bought over half of the entire market.
Right.
It's just that they're required to hold them, obviously for regulatory purposes, and use them as collateral in trades.
Right. Wow.
Yeah.
So then the sovereign debt crisis they're trying to prevent through all these machinations, is this just, it sounds like a confidence game to me. They're just trying to create the illusion that everything's okay as long as it's below a certain threshold, or said differently, the bond price is above a certain threshold. Is that what's going on here? Is like you're just trying to maintain appearances?
Yeah, that's exactly right. And it worked for a long time because of the factors we discussed before, right? Like the rates were so low and people were so, hesitant to spend, and money velocity was just near zero, and the aging demographics was pushing such a deflationary wave that they were able to get away with this confidence game for so long. And the key part was, for most of the 2010s, right, global yields were pretty low.
Yeah.
Like we had, in the US, we had rates at zero until 2016, and then COVID hit and we brought them down to zero again. And then not until 2022 did we start hiking again. And so the Bank of Japan was able to just keep gobbling and gobbling and gobbling their own bond market, and basically obviating the need for all the dealers to even work in their bond market.
Yeah.
And just buying these bonds wholesale. And it had, I wouldn't say no consequences, but it had delayed consequences because there wasn't an immediate, crisis that happened when they started doing this. But the result now is the Japanese banks don't want to hold JGBs because they're obviously yielding negative. They have negative yields in real terms. Foreign investors don't want JGBs on the long end. They only would want short end JGBs for like we said, collateral trades. And so the demand basically for JGBs is completely gone. And to get the demand back, they have to let yields rise, which they can't. And so now the only result is the central bank has to monetize these bonds forever. They're too deep now. They can't go back. This is continual monetization of their bond market, and they'll eventually get to, right, like if you follow the trend, they're already at 53%. Eventually they'll get to 100% monetization of their bond market, at which point there's not even a need for dealers. Just have the central bank directly print money and wire it to the treasury, and have the treasury issue the bond and wire it to the central bank. It's just plugging the liquidity hose directly into the veins of the treasury.
So this is pure debt monetization, right?
Pure debt monetization.
The government just spends whatever it wants and prints money to cover it completely.
Exactly.
And so all of this is really just a gradient going towards that, right? That's sort of the end game. And Bank of Japan is just the bank that's furthest along in that game. But the game, it sounds like the duration of that game, well, I mean, there's a lot of factors involved here, but the big one sounds to me like the willingness of the savers to keep buying and holding this shit, basically, right? So they're the one eating the purchasing power loss. It's, I mean, the central bank's not hurting, Japan's not hurting. It's the savers, right? Whoever's not just Japanese citizens, but I guess whatever international holders of these bonds there are. Is that correct?
Yeah, I would say broadly, right? Like that's, so what we saw with yield curve, so again, going back a little bit into the history. So they had yield curve control from 2016 until 2022, and they had the band set at basically at zero. And in December of 2022, they raised the band to 0.5%. So they basically said, okay, we'll let the 10-year, and again, this is a 10-year, there's a long-term government bond. We'll let it go to 0.5% at the highest end of the cap. And very quickly, the yield started spiking. They ran all the way up to 0.5%, and the bank had to start machine gunning the rate back down. They had to do emergency bond buying operations, and the Japanese Security Clearing Corporation that month issued emergency margin calls for all of its members. And so they were basically saying like all these people had crowded long JGBs because they didn't expect the government to change policy. Now the government let a little bit of, put a little bit of leeway, and then suddenly the bonds snapped, and there was basically a mini crisis, right? And the bank had to step in and do yield curve control again and defend that cap hard. And they just had to keep waiting as the rest of the world started to continue to raise. And this creates this unique dynamic of, the holders of JGBs don't want them, but they're able to, the only reason they would use them is to fund what are called carry trades. So they're borrowing, yen at 0.1%, 0.2%, and then they're selling the yen in the forex market, buying USDs, and then using the USDs to buy dollar assets that yield 5%. And the problem is, the more this trade builds up, the more shorts build up on the Japanese yen, and the more longs build up on the USD. And so that's why in that piece, for example, that I sent you, you see the yen just start to blow out in March of 2022, which is right when the Fed starts hiking. As the Fed is hiking higher and the delta between the yields start to grow, then all these carry trades start to be put on and the yen starts to get shorted to oblivion. And then as that happens, right, like all these people who are long yen or hold yen are suddenly underwater, and now they are forced to liquidate. And the Bank of Japan is now panicking because their currency is devalued 50% in 2 years. Right. And what do? Because they can't raise rates. So what they've been doing is yen interventions. They've been dumping in September 2022, and then again just last month they were dumping billions and billions of dollars of USDs to buy back their own currency in the market, which is the most insane policy if you think about it. Because as we covered, on one hand, they're still doing QE. So they're still printing yen to buy bonds, and then on the other hand, they're selling USD to buy yen. So they're like slamming the gas and the brakes on the train at the same time.
Because they're devaluing yen here.
Yeah, devaluing yen and trying to appreciate it here. Because it's blowing out. They're trying to save their bond market, but then they're also trying to save their currency market. And you can't do both.
And it's an impossible do dilemma. Both because of Trivin's trilemma?
Yeah, that's part of it. But I mean, just mechanics, right? You can't print money and cause excess reserves to be in one place and then be mad when those reserves show up in the forex market and your currency devalues. So you can't do both.
The visual is just like the dam is exploding and they just patch one hole, patch another hole. And you can't, I mean, the thing's coming apart, right?
Exactly.